Good afternoon and welcome to this week's edition of Halftime Talk. I'm honored to be joined from Copenhagen, Mr. Ole Hansen, the head of commodity strategy at Saxo Bank. Good afternoon, Ole.
Good afternoon, Sean.
Ole, perhaps I'll start with the big headline, given that you are head of commodity strategy and not just oil and not just energy, but across the commodity complex. The growing sort of sense over the last number of months has been the question, are we in another commodity super cycle? So I'll put that question to you. Are we?
Well, I think we are. Whether it's going to be as super turbocharged as we've seen in the past, especially from the early parts of this millennium, where China basically entered the world stage and hoovered up anything that resembled a commodity, that obviously remains to be seen. But what we are noticing is clearly that there's a green transformation focus going on that's now being supported both in Europe, in Asia, and in the US, and that will. And I think what we have to remember, in order to go green, you have to go pretty black first, because you need to get into the ground and get some metals out of the ground to support the electrification, which is supporting several metals. But it's also requiring a lot of energy, which will continue to underpin, I would say, oil demand at least for a number of years. At the same time, if you look at something completely unrelated as the agricultural space, we have seen years of oversupply suddenly start to tighten. We are now faced with the tightest situation in some of the key crops: wheat, soybeans, and corn since 2014. So that sector is also adding to the whole picture. So what we have right now is, as opposed to previous bouts of strength over the past, I would say, near half decade, is that we now have more of a synchronized rally taking place, and that's really
underpinning. All boats are floating, are moving upwards. It's the sort of nearly feels like the relief rally to an extent. But if you take the analogy of China being the engine of the last commodity super cycle of a decade or more ago, India is certainly well placed to perhaps be the driver of this one, and where we have OECD forecasting 12% growth in India this year, perhaps on a lower base given last year's traumas, but nonetheless, all the signals of India becoming the next big engine of commodity demand. Do you subscribe to that theory?
Absolutely, and I think in addition to that, if we are looking at this rollout of electrification, just imagine the almost hundreds of thousands of kilometers of additional wires that need to be dug in the ground just to ensure that we have enough electricity to recharge around the world. And I think that basically means that even India is absolutely going to be at the forefront of this. But if you look at the Western world, which has been less commodity intensive in recent years, that's really expected to be. There's going to be a revival there in terms of demand for something like copper, as an example, and that could also mean that the next growth phase is not necessarily going to be Chinese. They helped us through the crisis, through the pandemic last year, by once again adding a lot of stimulus to the economy. But that stimulus seems to be fading a little bit now, and that basically means that it will be other countries that will take over. But if I just may finish off the first section, because also what we have to be a little bit in the short term a little bit concerned about, and that's also why we've seen the commodity rally just fade a little bit over the past few weeks, is that rally we've seen in bond yields in the US since the early start of January. It has strengthened the dollar, thereby curbing the upside, and we've seen some very interest and dollar sensitive metals like gold has been struggling as well. And I think that's probably also part of the story why right now we're seeing oil just struggling here at the $70 level, because part of the story is not just the underlying fundamentals. It's also an investment story, and the investment case right now has been somewhat muted by the uncertainty about how far these bond yields can rally.
So when you take the flip side of that, that's the weak dollar, the strong dollar. We've had a very weak dollar for much of the last, nearly 12 months since the crisis kicked off. We had the rush to safety with the dollar strengthened quite dramatically last March into early April, but then has come off quite dramatically since. And you would think it's been a supporting element to the recovery of oil prices and energy and commodities in general, all priced in dollars. What's the consequence of a strengthening dollar to this moment in time as the global economy seeks to come out of the dark forest of the pandemic?
Well, it's one that will be would slow it down because the stronger dollar is not something that the world needs right now. A world that's loaded up on debt, a lot of that is in dollars, and emerging market economies, which obviously would benefit from a revival in the commodity space, but would be dragged down somewhat by the strength of the dollar. So the Goldilocks scenario going forward would be one of a stable to weaker dollar, and I think we probably will see that, because I think where we are. Where we're a little bit hesitant right now in terms of how the market's been behaving over the last couple of months with the rising yields is the fact that this yield rise has happened without a corresponding rise in expectations for inflation. And I think that's potentially where the market is right now, not pricing in inflation or the incoming inflation at a high enough level. And if we're going to be right on that assumption, then again just from an investment perspective, commodity space will continue to attract demand from funds seeking to hedge themselves against rising inflation.
I mean, the monetary policymakers, central bankers, particularly the Fed, have been very vocal in their disregard whether inflation is there, or B, even if it is there, they're not even going to be concerned about it. They will not acknowledge it, it would appear, regardless of where it goes. So what difference does that make, even if inflation does come, if the Fed and monetary policymakers just ignore it?
Well, they will have to. They can only ignore it onto the point where it just becomes such a theme, and or it becomes so visible in the numbers that they will have to do something. But then at that point, we may see at that point the damage may have been done, because there is potential for the $1.9 trillion stimulus that's now hitting the U.S. economy, that we are going to see economies being overstimulated, and that's
And
also.
they're already talking about a yet another one with the infrastructure stimulus, and perhaps that's going to be as bionic as another $2 trillion.
Indeed, and that's a risk that will add to price pressures, and right now it's not only from the stimulus that we're seeing that pressure. As I said, we're unfortunately seeing higher food prices as well. Energy cost obviously is going through the roof relatively to compared to where we were a year ago. That will show up in the data as well over the coming months. We got a dislocated global transportation system, where we got empty containers and sitting in harbors around the world, and where they can't get enough of them back in China, because all the stimulus we've been given had gone back to China in exchange for consumer goods.
Well, that's what container freight rates above $5,000 a container.
Absolutely, and that's putting up the cost of transportation, the final mile, as we call it, when the delivery truck then has to bring the parcel to your front door. That's going up as well, because I'm sitting staring out at my street in my local town, the local part north of Copenhagen, and just the number of vans, the transportation or delivery vans I see on a daily basis just in this little street just highlights how busy that whole sector is. So that's all price pressures that will start to filter through into what we pay for goods, and that's also part of the inflation story.
I mean, let's just drill down, no pun intended, into the oil piece within the commodity complex. Oil has seen, like others, but yes, it has been in some ways a laggard to other financial assets over the last 8-9 months, but it has come soaring back in the last 2 or 3 months, particularly in the start of the new year, since Saudi Arabia unilaterally cut 1 million barrels a day, more than was expected. And so we've moved ahead, and recently again, OPEC Plus kept their powder dry and curtailed new supply. And as a result, we're now knocking on the door of 70. Is that a sustainable price? Are we near the peak on that? What are your own thoughts and outlook, Ole?
I think in the short term, I think we're close to having reached the potentials given what we know right now. We have obviously a market that's being supported very successfully by OPEC Plus keeping supplies back from the market. I think that's going to be a very difficult one to continue to repeat over the coming months. And OPEC Plus is clearly just expecting that they just have to buy a little bit extra time because demand will come roaring back, and it's obviously all based on that expectation. For that to happen,
it looks like nearly every financial asset is based on that expectation that the second half of this year is somehow going to be some incredible nirvana moment.
Absolutely, and we have seen now for the past many months that OPEC, IEA, and EIA on a monthly basis basically been reducing their demand growth forecast for this year. So it continues to be pushed forward, and I think that is a risk here in the short term. Adding to this, calling U.S. shale dead is, I think, is way too premature, because we are just seeing right now in the stock market the move from momentum to value, and I think we already seen some of these energy companies having experienced increased or renewed demand from investors. So I think that we could easily see the U.S. shale oil production start to recover again, potentially not reaching its 2019 peak until 2023. But if we start to see a continuous rise then obviously that would worry some of the ministers
the
within the OPEC
challenge
Plus.
for shale has to be not so much where the absolute price is today, but the fact that there is still 8 million barrels of spare capacity on the sidelines within the OPEC Plus countries. I mean, shale is really much the marginal barrel, but how can it, if you're major Exxon, Oxy, etc., looking at that amount of spare capacity sitting idle, are you going to pump your precious few $1 billion into shale?
That's a very good question. I think they will, because again they will, but probably not as an aggressive step, because those 8 million barrels obviously need to be reduced, and there's expectation that they will start. We'll see at least half of that being reduced over the coming months. So I think we will move into 2022 and look for a recovering global oil demand that will take us back towards where we peaked in 2019. The big question, I think, is still, how are we going to behave as a global community when we get on the other side of this pandemic? Are we going to see more situations like we're seeing here? We're sitting at home, maybe not every day, but at least part of the time. How strongly will commuter consumption recover when we're on the other side? But I think,
but the flip side of that coin, and this is all the unknowns, is that if we do not commute, or we commute less, that there might be a sensitivity, as we saw in China, where more people got in their cars than get back into public transport, and actually gasoline consumption rose on the back of the fact that people were less willing to use the more energy efficient public transport.
That is another one. Yeah, plenty of unknowns to that we have to address over the coming months. But I think you mentioned the oil price, whether it's sustainable. What I've noticed, because we obviously dealing mostly with the paper market. We got investors buying and selling into the oil futures and CFDs and ETF markets, and then what we noticed from the hedge funds now for the past 4 weeks, that while the price of crude oil has rallied by more than 10%, the net length has stayed unchanged. Whether that's part of maybe some deleveraging occurring as yields are going up, that could be part of it, but potentially also just a sign that maybe there is some hesitancy in getting too aggressively long at these levels.
What is your concern about that record long position in the hedge funds?
Right now, it's not a concern, but I think it's the concern rests in the fact that the oil has rallied 12% during the past month, and it hasn't attracted any additional buying because there is still the record long is a couple of years ago, so there's actually plenty of room, I would say, to accumulate length at this moment in time. But it just could indicate that the hesitancy we've seen now for the past 4 weeks could indicate that the market is now saying, well, most of the good news has been priced in by now, and now we really need to see that demand start to live up to expectations before we prepare to let it move higher. And also just obviously the risk of a non-OPEC response starting to become more visible.
In terms of the outlook for gold, increasing real yields versus gold, we've seen the other element that's come into play here, Bitcoin. What do you see the correlation between those different elements?
I think there is I don't think you can ignore that there is some kind of correlation or relation between gold and Bitcoin. But I think that correlation mostly belong in the more speculative part of the spectre. Those who are looking for a quick turnaround, they've become quite disillusioned by both gold and silver in recent months, whereas Bitcoin has provided a lot of ammunition, but also some big corrections. And I think so far this year we've seen, or the past few months, we've seen Bitcoin had a 30% correction, and then it had a 23% correction. If you are a family office, or you're one just you're concerned about storing your wealth and maintaining your wealth, I don't really think that it's an alternative. It's a great speculative medium, but I also you just simply also still have to question: is Tesla going to be the winner in 10 years' time in electrification? Maybe not. Maybe. Is Bitcoin going to be the winner in 10 years' time? Maybe it doesn't exist in 10 years. Maybe something else has turned up. So I think
Well,
from
it's
that.
one of those assets, and we've seen a few where the upside seems that it can be somewhat curtailed, but the downside seems to be quite a dramatic risk. I mean, that profile is there. Looking out beyond back to oil, Ole, we're always, it seems, only a few days or weeks away from the next OPEC meeting, which is now on April 1st. They surprised us last time, and they surprised us the time before that. How important do OPEC have this oil market in the grips of their hands? It seems this is a market that is heavily propped up by this tight supply constraint, 8 million barrels of idle supply. This price is holding by the fingertips on that. What's your outlook for OPEC's next decision?
Well, I think if they don't raise production next time, I'll take that as actually a sign of weakness, which is a little bit perverse. But the fact that after the market was expecting an increase in this latest meeting, if they cannot raise production next time either, that will be a reflection of them not seeing demand being strong enough to justify an increase. So I think they will increase. Also, we are heading towards the summer months where the domestic consumption will go up, especially in the UAE and in the Middle East in general, and that will support an increase in production. But I look for a production increase. We'll just have to see on how the demand stacks up over the coming weeks in order to try to decipher more closely how.
But it'd certainly be interesting to
be.
see. Be interested to see what the IEA says this week in their monthly report due on Wednesday. If they, as you articulated earlier, continue to downgrade their demand recovery forecast for 2021, that will give OPEC plus pause to think about exactly when is this supposed demand recovery going to happen, because it hasn't started yet, and the forecast is 5.5 million barrels a day. We're already at the end of the first quarter, so that means the subsequent quarters are going to have to be much more than 5.5 million barrel of recovery if we're going to hit those numbers.
Absolutely, and I think in that lies really the risk that if that the market will if they don't do any increase and we're still staying around the $70, then the market will start to look at the downside risk more than the upside, because then we basically got oil prices pumped up to $70 without the demand being strong enough to sustain it, and that could raise some additional risks. And we already see now protests in various countries. I think India is probably the most important, because they have been raising taxes during the period of low prices. Now they're balking at these higher prices and may have to adjust taxes in order not to have an negative impact on demand. So it's a tightrope that we most certainly need to see that demand recovery start to pick up fairly soon. And with the vaccine rollouts, that should happen over the next few months. But so far, we're only seeing pockets of it.
Let's just wrap up, Ole, on Europe. You're obviously sitting in Europe, in Denmark. We have a few issues there. Let's say the recovery. We have the stimulus, the Great Green Deal, which is part of that European stimulus. What's the outlook for Europe, do you think, over the next 3 quarters coming out of this sort of peak pandemic period?
Well, I think the outlook is fairly promising. We can see if we just look at the stock market, they have obviously been doing well, because stock markets in Europe has a much higher share of these value stocks. So that's one part. But I think in general we are looking for the vaccine, even though it's been desperately slow, to continue to have a positive impact. And interest rates, well, we are starting to worry a bit about interest rates in the US going higher. I think the ECB is in no mood to make any changes anytime soon. So we're fairly constructive on Europe over the coming months.
But how do we extract ourselves in Europe from the sort of stimulus, the bailout money, the furlough, all of these jobs that are being kept alive, all of these companies that are being kept alive by government programs as they wind down in the second half of the year? What's on the other side of that hill?
Hopefully an expectation that they will not be needing that lifeline any longer. And basically that also means that a lot of companies have not been forced to let go of their employees, and it means that they are ready to hit the ground running when and if the demand dictates that it's possible. So potentially that should help us come roaring back fairly strongly. But again, like anywhere else in the world, we have been loaded up on debt, and the question is what the governments will do about that as the next stage, because tax rises are potentially on the horizon, which could be a drag.
Last question, Ole. Nord Stream 2, the US still seems determined to sort of lock it down. What's your own thoughts on its outlook and Europe's need for that gas coming in from Russia?
Well, it's going. Part of the line is going straight through Danish territory, and there's been so we have been involved in that on a number of occasions. I think the fact that it hasn't been scrapped at this quite late stage, I think could indicate that we are going to see it come into force. But even though we have gas supplies coming in bigger quantities from Russia, the emergence of LNG and the ability to ship LNG across the world has I think has been a major change in recent years, where we've gone from three local prices, US, Europe, and Asia, to a much more harmonized world, apart from obviously like the winter we just had, where suddenly Asia ran out of supplies and prices spiked. But generally, we are in a position in Europe to be looking for supplies not only from Norway and Russia, because of the ability to transport.
I think I would concur with that view. I mean, it's hard to see how Nord Stream 2 gets stopped at this stage, 80 or 90% completed. Ole Hansen, Head of Commodity Strategy at Saxo Bank, thank you so much for joining us on this week's Halftime Talk.
Thank you very much, John.